welcome to the 3Edge Week in Review for the week of March 11th. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3Edge Asset Management. Today, I'm calling in from the road at another conference this week, meeting with advisors who utilize our 3Edge strategies. And in today's video, Steve and I will be discussing the continued strength of corporate profit margins, which are currently over 12% on an after-tax basis. And we'll look at the outlook for corporate profits going forward and what different scenarios for future profit margins could mean for the economy and the markets. Before we get to that, we'll take a quick look back at last week, which featured several reports on the state of the U.S. economy for investors to digest. And during the past week, reports on both producer and consumer prices came in higher than forecast, indicating that the battle to tame inflation from here could prove more difficult. At the same time, reported consumer spending came in lower than anticipated, which could potentially be a warning sign in terms of economic growth for the remainder of 2024. And as we know, the Fed operates with a dual mandate. They are charged with maintaining price stability, which means keeping inflation in check, along with maximizing employment. And if you take the economic reports that we've seen this week in aggregate, they would probably suggest that the FOMC will leave rates unchanged, still at a two-decade high for the fifth month in a row at next week's Fed meeting. So, with that, let's take a look at the current state of corporate profit margins, which I said are quite elevated. But Steve, I think maybe to begin, maybe a working definition, like when we talk about corporate profit margins, what are we actually measuring? And I think I have a second part of that question, if you don't mind, and that is just why are corporate profit margins so elevated at the current time?
Well, Fritz, one way to define profit margins for a company would be to take the earnings that the company generates after subtracting all expenses, including taxes, and dividing by the sales revenues that they generate. And so we're looking at how much money can they make as a percentage of all the sales that they generate. And if we want to do that same metric for the stock market as a whole, we can look, for instance, at the S&P 500 index. We can take the earnings per share, it's after-tax earnings per share, divided by the sales per share, and we get a percentage. And I want to point out the chart that we have accompanying this. And in the chart, we're looking at the profit margin of the U.S. stock market going all the way back from the 1920s to the present. And what you'll see is that over the long run, the average profit margin is just a little below 8% on average. Sometimes the profit margin falls precipitously and goes below 4%, and sometimes it's really elevated above 12%. And right now, this is one of those times where we're very elevated. In history, the very few times, in fact, only one time, that it's been over 12% for more than just a blip. So you ask, why are profit margins so high? Well, there are a number of reasons. One is that not too long ago, we had a very strong tax cut for corporations. We had a big corporate tax cut in a few years ago. We had corporate financings done at all-time historically low interest rates. So the combination of much lower than average tax rates for corporations and much lower than average interest rates for their interest expense that they have to incur certainly elevates profit margins. And that's something that happened in the past, but still is carrying over to today. We also have had some early productivity gains with AI, and I think that most of the productivity gains from AI are going to come well into the future, but we're already seeing some gains now in the promise of future gains. It's true that companies right now seem to have a lot of pricing power, able to not only pass along their costs, but to raise prices faster than their costs are going up, improving their profit margins. And some of this is because in certain sectors of the economy, we have companies that have monopoly-like powers or duopoly-like powers that allows them to price. Another factor is that economic growth has been better than expected. And when corporate management's been worried about economic growth slowing, they've retrenched a bit, they've cut expenses, and then when growth is higher than expected, it allows them to scale and distribute those costs over more sales units, and that helps profit margins as well.
Excellent. So with these profit margins so elevated, maybe you could lay out, the scenario from here and look at both what would be the positive outlook for profit margins and what might be a more negative scenario for the future direction of profit margins for the remainder of this year and even beyond.
Well, as we saw in the chart, the profit margin is higher than it's ever been since 1929. And is that good or bad? And there are elements of good and elements of bad. So the positive scenario is that, yes, profit margins are exceptional. And the hope is that they'll continue to be exceptional for some time and keep driving this market higher. And so what would be behind that? What would be the positive scenario? Well, it would be, number one, that this economy continues to grow and maybe above expectations. Number two, any efforts for antitrust to try to break up companies and break up monopolies takes a step back. Number three, corporate tax rates stay really low, and they're much lower now than they used to be in the past. Number four would be that interest rates actually fall from these levels so that companies can finance their debt in the future at lower and lower rates. So that would be the positive scenario. Now, there is a negative scenario, of course. And one thing we know about profit margins is they're mean reverting, meaning that when they're way above average or way below average, there are natural causes that will tend them to go back to average. And right now, we have a case where profit margins are way above average, and there's no magic timing as to when they will come back to average. But with the proper catalysts, they certainly will at some point. So one factor that always exists is that when you have really high profit margins, it invites more competition, and that competition eats away at those margins. And that's really at the core of capitalism. And it's good for consumers when you have competition. Secondly, we could have an economy that instead of growing faster than expected, could grow more slowly than expected, or we could even have recession at some point in the future. And that certainly cuts profit margins because the top line comes down faster than the cost line. Antitrust could get more aggressive. Corporate tax rates could rise, not fall. Interest rates could stay higher for longer. And the geopolitical conflict that's happening could, if it gets even worse, we could end up seeing an oil price spike. And then all bets are off. We could have stagflation. And stagflation is probably the worst environment for corporate profit margins.
Excellent. And so, as always, my final question is based on what we've discussed here today about corporate profit margins and those two very different paths that you've laid out. How should investors think about positioning their portfolios?
So, because corporate profit margins are doing so well right now, that's great news in the short term, but not necessarily good news in the long term, because eventually they will mean revert. So part of it is, are you more of a short-term trader, speculator, investor, or are you more of a long-term investor? And that takes some introspection. And also what you and I have discussed in the past, pain management. Do you feel more pain from fear of missing out on the continued rally, or would you feel more pain from losing money in a correction? And that's why at 3Edge, even though all our portfolios are based on and driven by our intellectual property and our research models and our investment committee experience, we do cater to people at different parts of that risk spectrum. So, we have a more conservative strategy, we call it conservative, that caters toward those who would feel much more pain from losing money. We have a more moderate strategy that's a balance of both. And we have a more aggressive strategy, our growth strategy, that would tend to help those that have fear of missing out. And we also have some all equity strategies that would cater that as well. So part of it is an introspection on where do you fit on that spectrum. in recognizing in the short term this momentum could continue, but in the long term, a correction is not only possible, but it's probable, and because of the degree of overvaluation, it could be quite severe. So what we think is, for many of our clients, they want a balance between the two. Total return strategy does offer that balance. For some people that do have some fear of missing out, they complement that with one of our equity strategies or migrating to our growth strategy. And within our strategies, we do want to and advocate balancing the equity investments that we have with hedges against the potential for equity to fall. Not only do we have the opportunity to tactically lower the equity percentages in our core strategies, but also we complement the equities with hedges like shorter-term treasuries, gold, and tips, which could all do well when other things do badly.
Excellent, terrific. And I know that we often have those conversations with our clients, and that difficult, that introspection, if you will, about trying to understand what their risk tolerance is and what their return targets are. So I do feel like we can be helpful in that area as well. So, Steve, thank you very much once again for your insight. That will do it for Steve and me for this week. We'll be back again next week with another edition of the 3Edge Week in Review. Remember, all our videos always available on our 3Edge YouTube channel. And if you know someone who might enjoy or benefit from our weekly videos, please feel free to share them. And so, until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.